Hey guys, welcome to another Trade Genius podcast. Philip here with Bob. The Bank of Japan surprised everybody the other night with this surprise policy shift, and you need to know what that means because it's going to be detrimental to the markets. And so we're going to show you exactly how that works and how it relates to everything around us. So stay tuned.
Trade Genius.
All right, Bob. So pretty radical decision here that most everyone wasn't expecting, and that was that the Bank of Japan was going to surprise us with a policy change. And I know that you've kind of dove in on this. So can you explain to us what's going on here?
Yeah, so first of all, everybody got it wrong, and nobody ever expected Japan to get away from, because remember, Japan is a mercantilistic country,
Right.
meaning that they live and die by exports. So this is an anathema for them to not try to drive their currency weaker. And the only reason why they did this is because they obviously had to. So they're probably worried that they'd have a runaway devaluation of their currency, which they do not want. So they felt that they were losing control, and they raised their interest rate, or their band as they call it, and they're going to allow for higher inflation in the country. And then you do that by raising interest rates. But the other thing you get with this, Phil, is now capital is gonna flow into Japan. And I think it's kind of ironic that at the same time they did this is when Japan announced that they're increasing their defense spending and going to become the third largest military spending in the world. So I don't know if they want to reindustrialize or they're going to go into a higher kick here in terms of next level Japan Inc. But we'll find all that out into the future. But what it means to us is that we can probably kiss the pivot goodbye for PAL, and the two carry trade countries in the world are no longer carrying. So the dollar and the yen were the two carry trades for the longest time. Obviously, PAL killed the dollar carry trade, and now you have the yen carry trade blowing up, and that's very bearish. I don't know if people have kind of thought this thing through yet, but the gold market certainly figured it out right away. Did you see the silver and gold miners, Phil? I mean, up 5 to 25% on some of these miners. Now, I'm getting a little nervous here. I mean, I'm excited about it. I didn't put any trades on, but I have gold and silver miners in my long-term portfolio waiting for this day when the central banks cannot contain this anymore. And I believe also that Bitcoin got a bit of a bid on it too earlier in the day as well. So I think what's happening now is the true carry currencies are going to come into fore, is the non-yielding ones, gold and Bitcoin. So it's going to be really interesting. I think this is dollar negative. It's stock market negative because money is going to leave the U.S. market. Remember, the Japanese household had been investing outside of Japan for, decades. And if this thing reverses, that means all that money is going to come flowing back into Japan, and it's going to leave Australia, and it's going to leave the United States, it's going to leave Europe, and it's going to go back into Japan. So it's going to be a dollar negative, stock market negative, gold and silver positive. And I think the energy market's just looking to see supply and demand. So I think it's its own entity at this point. So those are my thoughts on it. You trade currency. So what do you think about all this?
Yeah, I was going to actually look at the chart. But one thing you noted too was that they wanted to step up the defense spending. And I thought, that makes a lot of sense to me because this action here, and we're going to look at the chart here in a second, strengthens the yen, right? So if you're going to be a buyer of things, then you want a very strong currency, which has not been the case. So when you said that, I was thinking, this makes a lot of sense why they're, maybe not, the policy change may not have been just because the currency, they're worried about hyperinflation, but this other policy of, strengthening or stepping up their defense spending actually is probably a bigger driver of the policy shift here. So I thought that was an interesting point. But yeah, to go into the next chart here. So what we have here is a chart basically of on this side of the window, we have the yield, okay, in terms of percent. And the red line is basically where they really started to have to burn a lot of yen to keep their yields from rising. So for those of you that aren't quite, versed in how the bonds work, if people are selling off bonds, like people don't want the government bonds anymore, let's just say I just don't like Japanese bonds, I don't want them anymore, I'm gonna sell them all, it forces their yields to go up because they have to entice people to buy their bonds. Okay, if people are flooding into the bond market, then the yields drop because they don't really have to incentivize anybody to buy those bonds. All right, so the problem here was that the world really didn't want Japanese bonds. So what they had to do was they had to buy their own bonds, basically. And what that does is that creates a bearish strain on the currency. Now, on the right side here, you have the basically the yen futures, or the performance of the yen. So you can see that starting here around February of this year, they really started to burn a lot of money to keep their bonds from spiking higher in yield. And why would they do that? Well, it's because they know long term they can't afford higher yields. So they were trying to peg it. But the market has a funny way of calling bluffs, and they basically said, they cried uncle here because they couldn't, I think Bob's right about the defense spending, but also too, inflation is becoming an issue for the country. So they said, fine, we're going to let the bond yields go up to 0.5%. Oh, but wait, doesn't that make your debt pretty expensive to pay back? Yep, it sure does. So while short term they can get away with this, especially if they want to spend money on defense products, longer term this is going to have to come back down. It's with the amount of debt that the Japanese have printed and put out there, they can't afford this. They can't afford it to go higher either. So eventually this is going to come back down. They're going to go back to yield curve control, and they're not going to be the only ones either. It's going to be the US too. But in terms of charts and yen, the yen's probably going to go back up and probably test it. A lot of times what happens when you have a fundamental shift in policy, you're going to go back to areas where you had a catastrophic break. So that means this is going to run up. And I think all the while this is running back up there, like Bob said, I think it's going to be negative for the dollar and negative for the market. So I just wanted to show you guys how the relationship here works, and you can see just how blatantly obvious it was that it was just killing them, killing their currency to try and prop up this bond market. And this is what governments do. They can fake it for a while, and then sooner or later you got to pay the piper, and that's what's happening here.
Yeah, the other thing too is that this could also be a little bit of tell on the Japanese not believing that. Remember the chart you showed on over the weekend where with the double rip inflation? The Japanese are pretty savvy traders, so they could be anticipating, hey, Biden's going to be refilling the SPR. We better get our currency in a position where we can contract out at a better yen to capture our energy, because they have to import natural gas and oil into their country, and some food. And so this might be a play there for them to bump up their yen so they can do some importing before they start putting their export currency policy back in place. So it's some things to watch. But yeah, I agree with you, Phil. I think these things never just end. Somebody's going to test their resolve here by taking it back to the breakdown. I agree.
Yeah, so until then, I think we're in agreement. It's going to be tough for the markets in the interim, which goes along with a lot of other things that's been bearish that we've been covering. So we will all get through this, but right now we just got to deal with the realities and protect ourselves. So yeah,
look, everything's tying into maybe a February bottom or a March bottom, but a big move down. Everything's lining up. So eventually you'll get themes from us that are of FOMO in nature, but right now we're in the oh no markets.
Yeah. All right, guys. Well, we hope you found that helpful, and we'll keep you abreast as things progress regarding this. Otherwise, thanks for watching. Please hit like and subscribe. It really helps out our channel, and we'll see you on the next video. Thanks a lot. Bye-bye.
Trade Genius.